Hello and welcome to the special edition of the Global View with me, Tanvir, Gill. My guest today on the show is Mihir Worah, who's the Chief Investment Officer Asset Allocation at PIMCO, and he joins me to put the globe in perspective, as also highlight what he expects the Fed to do in its upcoming policy meet. Mihir, it's great to have you on the show. Thanks very much for taking out the time to speak with us. Let me start off with the obvious question. What do you expect the Fed to do this time?
So before I start, Tanvir, let me say it's a pleasure to be talking to you again. As far as the Fed is concerned, obviously we'll find out more in a couple of days. But we think chances of them raising rates at this meeting on Thursday are fairly low. I'd say a 20 to 25% probability. However, they are likely to raise sometime this year with a message that any future hikes are going to be slow, careful, looking at both domestic and global economic situation, as well as, most importantly, looking at what inflation is doing domestically and globally.
But how are you playing out scenarios, Mihir? Do you believe that there's a higher probability of a hike in December? If not now, then surely in December we would see a rate hike from the Fed?
Surely is a tough word in the financial markets, but I think odds are high probability that there will be a hike in 2015. Low probability that it happens in 2 days in September.
Okay, and what about the chances of a rate hike being pushed to 2016?
I think that's quite high. I think we're going to see the first hike with a messaging of a gradual pace probably in December, and then I think there may be another 1 or 2 hikes maybe in 2016. The Fed has made it very clear that they're data dependent. If, as we do expect, we think the U.S. economy is in pretty good shape, the consumer's in good shape and spending. Clearly, the stronger dollar, lower oil prices hurt capex in a certain sector of the U.S. economy. The stronger dollar hurts the export sector of the U.S. economy. All that said and done, we think the U.S. economy is in pretty good shape. It's going to grow between 2.25% and 2.75% over the next year. So economically, growth is good. It really depends on inflation. We think slack is shrinking in the U.S. economy. Wages should start to go up, and the inflation numbers should start to go up. If that happens, we'll probably see more than a couple of hikes next year. If inflation doesn't pick up, then probably a couple of hikes and we're done.
Sure, but Mihir, if your outlook on the U.S. economy is positive, then wouldn't it be prudent for the Fed to actually, give the market a token rate hike? I mean, either way, there's been talk about how the range, the Fed funds range would be compressed to a median point of 0.125%, add 25 to that, and make it seem like a bit of a disguised rate hike where you're giving a rate hike and yet you're being cautious.
Sure. I think the predictions on those blue dots and the median expectations for 2015 and even longer term should come down. And they will probably come down in this week's meeting. So their long-term neutral rate, which they have at, which used to be 4.5%, has come down to 3.75%, probably comes down some more. And that, is in line with what PIMCO has been calling the new neutral, that the neutral Fed funds rate won't be 2.5% like it's been, but will be 0 to 1, will be almost 0 to 1% real, so around 2 to 3% in nominal terms. So we see the Fed doing that, lowering the dots. However, I think a lot of the volatility in the markets, clearly there's volatility, and we'll talk about emerging markets and China and volatility in markets, and there's always volatility around the time when the world central bank, which is the Fed, is going to change its policy. However, I think a lot of the recent volatility has been around this thought that the Fed is going to hike rates at the same time as inflation is clearly very low, and there's some doubts whether inflation can move higher. So for the Fed to hike in this week, they've got to be confident that inflation is going to be moving up, and for them to hike in the face of tightened financial conditions, volatility in the market is up, equity markets are down, inflation expectations are low. This means financial conditions have tightened, and this weighs on economic growth. What happens in the markets, what happens with the equity market, what happens with volatility, what happens in the bond market, impacts real growth. Now the Fed really doesn't care about the markets. They care about, is the economy growing or not. They care about the markets because what happens in the markets often impacts your return on equity in the stock market, your cost of capital in the bond market. So given the volatility in the markets, given how low inflation expectations are, we think that the Fed would be sending the wrong message by hiking now. Obviously, it's not a zero probability. There is a case, like you said. Let's, what people have been calling, the dovish hike. Let's hike, but have a very dovish message saying, we're not going to go again in 2015. This is just to get off the zero bound, et cetera, et cetera. So I'd say there's a 20, so it's not a zero probability. It's a 20 to 25% probability that they hike this week.
Sure, Mihir. So there's good data and there's not so good data. The good data is in growth numbers, the jobs market data, consumer spending is picking up, demand is coming back, corporate earnings have improved. And the not so good data lies in, like you pointed out, inflation undershooting the Fed's target. But it's been 10 years since the last hike, nearly 10 years since the last rate hike in June of 2006. Do you not think that this has also become a timing issue where the Fed needs to at least give the markets an indication or put the markets at ease that a lift-off is pretty much the scenario that they're working with and they want to get there sooner rather than later?
Sure, that could be a factor. They've said they're data dependent. They're certainly meeting the growth side of their objective. But again, it would be very, so there's a 25% probability that they go, but I think it would be quite unsettling for markets, for the Fed to hike rates when inflation expectations have been so low and falling. So I think they'll wait to get some certainty. In fact, in the U.S., we get an inflation print tomorrow, one day, and the Fed will see it. But obviously, one data point doesn't make a series. But once they have confidence that inflation is moving up, inflation expectations are stable, they'll have more confidence in hiking. But and like we said, at the end of the day, it's the pace that matters. It's the terminal rate, where they end up, that matters. The first 25 basis points don't really matter, other than the signaling effect of, there's a group in the market like you're suggesting that says if the Fed raises rates, it signals confidence in the U.S. economy.
Yeah,
but there's another group that says if what is the Fed thinking? Inflation is around 1%, expectations are down. How can you even think of raising rates? The dollar is, rallying. How can you even think of raising rates in this situation where you're missing on the inflation target by so much?
Okay, then fair enough. Let's talk about the market impact since you mentioned the dollar. Do you think that the dollar trade has priced in most of the tightening cycle, or is there more to go once rates actually edge higher?
We think the dollar strengthening that we've seen over the last 18 months probably continues at a slower pace. We think whether it's against the developed markets, a basket of euro and yen, or whether it's versus emerging Asia, and we can talk about that. Probably the move's 75 to 80% done. But all that said and done, the U.S. is still the strongest major economy. It's growing at like we said, 2.25 to 2.75. Nothing super exciting, but it's still the strongest major economy. It still is the world's reserve currency. It's still, whether it's September or December or January, the Fed is still the only major central bank in the world to be hiking rates, including the PBOC, including the RBI, including the Bank of Japan, ECB. No one's close to hiking rates. So the dollar should continue to stay strong, but I think about 70 to 80% of the move is done.
Mihir, if you look at the past pattern, markets, especially equity and commodity markets, have rallied post a first rate hike by the Fed. And within equities, if I could be specific, it's emerging market equities which have done really well post the rate hike. Do you think the scenario is pretty similar now as well, if you were to go by history? And I'm not including 1994 because that was an exception, but in other rate cycles, that's pretty much been the case. Do you think that's how it will be this time around as well? Because developed market assets are actually going into the event relatively stronger to emerging market assets.
Right. So typically, obviously, this is going to be a very unusual Fed hiking cycle. The Fed is going to be hiking rates, as we discussed, just to get off the zero bound. The Fed doesn't want to slow down the economy. Typically, when the Fed is hiking rates, you're well into an economic boom which then impacts equity markets, emerging equities, etc. Right now, we're not in an economic boom, so it's a very different hiking cycle. The emerging markets, clearly there's pockets of opportunity in the emerging markets. We like, certain emerging market equities. They're cheap, they're beaten down, and we think they'll do well. We like, believe it or not, in the portfolios that we manage for our clients, we have exposure to the Chinese H shares at a P ratio of 6 to 7, with easing measures to come out of China. Clearly, the markets, everyone's really worried about what's really going on in China. We think the economy is going to grow at 5.5% to 6.5%, and there's going to be continuous easing measures coming out of the government in China. So we like H shares. We like the Taiwan market, trading at a PE of around 11, with the currency weakening. So there are certain emerging markets that we like. Meanwhile, there are other emerging markets that have been over-reliant on commodity exports. Brazil being a good example, whether it's the Brazils, the Venezuelas, the Russias, that are a little more risky. So we like certain, so the emerging markets, you can't treat it as an asset class, but you can certainly find select opportunities within the emerging markets.
Let's talk about your asset allocation decisions then. You have indicated in the past that you are allocating more to equities than debt. And within equities, you're allocating more to developed market equities than emerging market equities. How are you gauging the risk in EMs? And at what point do you believe the risk-adjusted return would look favorable to perhaps, increase investments in emerging markets?
So we don't view the emerging markets broadly as an asset class. Again, like I said, finding opportunities, yeah, sure. But broadly as an asset class, I would still be defensive on the emerging markets. And clearly with bond yields where they are, if you're making the choice of, and valuations are rich everywhere. Valuations are rich in the bond market. Valuations are somewhat rich in the equity markets. It's the central banks that are supporting these markets, and we think they'll continue to support the markets. So you have to stay invested. There's been a lot of volatility, but we don't think it's time to just be in cash or be short. It's time to stay invested, find the markets that will do well, and I don't think it's the time to wade in to either emerging market stocks or bonds or currencies, given our expectation that commodity prices stay muted, and given that the market is just digesting this slowdown and this transition that's going through China. We don't expect, our base case is not for a hard landing in China. Yet, given a Fed that's likely to raise rates, given the uncertainty around commodity prices, given the uncertainty around the second largest economy in the world, which is China, I think you want to be careful. Emerging markets have their the liquidity issues and the governance issues. Take a country like India. It went through its fragile 5 problems when commodity prices were high, current account was lousy, inflation was high. It solved it. New government, new central bank governor, inflation coming down, better policy, and now, India. We can talk about it. I think valuations are high, but is an attractive emerging market to be in. Other countries like Brazil, which were favored, are now having the same kinds of issues: inflation running away, lack of infighting in the government, lack of credibility.
Just on that, just on that point, does that mean that the downgrade that we've seen in Brazil, that we've seen across EMs, Russia, start of the year, is really an opportunity to look at Brazil, Russia, perhaps even Turkey in new light, be contrarian there? Because in the past, again, these downgrades have typically worked as wake-up calls for the market and the economy of the region to actually rebound.
You can look at them, but till you see a desire to change policy, it's hard to invest. Clearly, valuation is attractive with 15% government bond yields in Brazil, so you should look at it very closely. But it's volatile until they get inflation under control. You don't want to make a bold statement there.
Okay, fair enough. Then where have you been increasing allocations, across your funds, across products over the last 2 months, particularly in this market volatility? Where are you building positions?
So over the last couple of months, I've on the equity side, we already talked about it. One of my biggest new allocations has been increased allocations to Taiwan. I think it's an attractive market, relatively cheap and poised to do well. On the bond side, we've been adding, especially in the developed market sector. We like the financial sector in the U.S. I think bonds issued by banks are trading quite cheap. Obviously, banks are going through the regulatory cycle. They're less profitable, but that said, they're kind of unloved. They have to raise more debt, raise their capital ratios. That just makes them safer. So for a bond investor, U.S. banks are attractive, as are bonds related to the housing sector. We think the housing sector in the U.S. will stay strong. Well, house prices will go up at 4 to 5% a year, and we like bonds related to the housing sector in the U.S. I've increased allocations to those, and I've increased allocations to, in the equity market, increased allocations to equities in Taiwan in particular.
What about India and China then? Have you increased allocations there too?
So I have a small overweight, like I said, to the H shares. I think at a multiple of 6 to 7, quite attractive. I think the Indian equity market, while the long-term story for India is a positive, I think the Indian equity market right now is somewhat rich, trading at whether it's around a 20 current PE or 15 to 16 forward PE. So a lot of the good news in India has been priced, and now the government in India has to get over its own infighting and start to prove itself. So there was a lot of euphoria. The Indian market did well after the Modi government was elected. Meanwhile, and it's well known in India, right? There's whether it's the GST, whether it's the land reform, a lot of things because the BJP doesn't control the Rajya Sabha. A lot of reforms are stuck, and now the issue is making wise reforms. One is the opposition party has to think about the good of the country and stop just infighting, which is basically Congress, stop blocking everything. And then the Modi government has to make smart reforms. Just constantly supporting, big business isn't the right answer. They have to make sure that they value the environment, they value human rights, and then they can go ahead and make the reforms. So I think as far as India is concerned, a lot of people are watching for what happens in the Bihar elections in a couple of months and see how the BJP comes out there.
Right, but for funds such as yourself, you would also be monitoring the rupee very closely, and given its relative strength to other emerging market currencies, do you think it still looks relatively stronger and perhaps has seen its bottom at around about 66.50 odd levels?
I think the rupee is definitely more attractive relative to most EM currencies. One is it doesn't have either a big commodity or goods related export sector, and then finally the carry, those 7% interest rates that you get in India are quite attractive in a market where inflation is actually coming down. So if you're getting 7% interest rates in a country where inflation is likely to come down, then the currency is attractive. That said, just recently we got pretty alarming current account numbers in India. We're back to 10-12% deficits, like the bad old days. I suspect this is because of the recent volatility around Asia and emerging markets and hot monies leaving India, but basically lower oil prices, lower commodity prices, falling inflation, support, and that attractive 7% yield make the Indian rupee attractive relative to other emerging market currencies.
The bond yield in India is signaling that we perhaps might be looking at rate cuts coming in from the RBI. Do you expect the RBI to be measured in cutting rates, or could they surprise with an aggressive stance?
I think if the Fed goes slow and easy, which is what we expect, and inflation, most importantly, every central bank, they worry about external factors, but they need to worry about domestic factors. If inflation does indeed start to come down. Now, obviously, the monsoon hasn't been that great in India, and food prices have started to creep up. Now, central bank policy can't really affect the weather or food prices, but the worry is higher inflation in food prices feeds through to higher, wage demands and higher inflation elsewhere. So the RBI has to be careful. But again, our base case is X of, some short-term dynamics in food prices, that overall inflation in India should be coming down and give the RBI room to cut. Whether they cut another 75, I don't know, but I think they will cut 25 this year.
Sure. Then where does that leave the growth story for India? Because that's a key variable. The world is searching for growth, and India is showing promise of that relative to other economies. How do you map the growth trajectory from here?
I think the growth trajectory for India is positive. The long-term story is undoubtedly good. India is going to be growing at 7% plus. It's the well-known demographic dividend, which is the youngest country in the world, and so this expanding workforce. So India is going to be one of the fastest growing countries in the world, but it cannot be the growth engine of the world. It's still too small an economy. It's not a China. It's not a United States. So India can be a regional superpower. It can be one of the fastest growing countries in the world. But it's not the growth engine. If India grows fantastically, but if the US slows down and China slows down, the global economy is going to slow down. So India is going to grow, be one of the fastest growing economies, but not the growth engine of the world. But that said, as we discussed, near term, India needs to get over its political stasis. It needs to just having a demographic dividend. If you've got a government that does nothing, we cannot unlock that demographic dividend and all the good things that India's got going for it. So we need some unlocking of this paralysis in the government.
Okay, so then let me ask you a very pointed question. You believe that the Indian market is fairly valued. If I were to ask you, what would be your top 3 reasons to increase allocations to the Indian market? One of them you already highlighted. You want to see reforms come through, faster implementation on that front. 2 more reasons that would make you allocate incrementally to the region.
The reasons would be if I saw inflation coming down, if I saw the RBI be able to act completely independently, and then thirdly, as I said, if I saw whether it's reforms or whether I saw a strong majority. For example, if the BJP gets a majority in the Rajya Sabha, either directly or through a coalition, then I think that's very positive for Indian equities.
Mihir, since you mentioned China and you have investments there, 2 quick questions on that market as well. Why is the world worried so much about China if one has to work with the argument that the Chinese authorities are doing what it takes to fix the market as well as economic problems that they're facing? So maybe one should look at the issues in China a bit dispassionately.
China's a big worry because it's basically the 2nd largest economy, and somewhere an economy that's somewhat opaque. You don't quite know what the numbers are. It's slowing down. People get that. It's going through this transition. People got all of that. The reason it got a big worry is the Chinese government was thought to be omnipotent and completely reliable, always making the right choices. Their reaction to the equity market correction, we think the equity market correction in China is not a big deal for the Chinese economy. Up 150%, down 30-40%. It's not the end of the world for the Chinese economy, but the reaction, the kind of panic reaction to it, and then the untelegraphed and sudden devaluation of the yuan, both of those have left some doubts about the credibility of Chinese policymakers, and that's why people are so worried about it.
And lastly, Mihir, because a lot of the China risk is about yuan devaluation, given that the yuan pegged to the dollar made it overvalued, this devaluation move should just be seen as a correction, an adjustment of the currency to fair value, reflecting the underlying fundamentals of the Chinese economy, and to that extent, it's part of the cost?
I think China is moving towards opening its capital account, and this devaluation and allowing more volatility in the yuan rate is the first step in that direction. I think the Chinese policymakers will ease policy by more internal easing measures, whether it's fiscal stimulus, reserve ratio cuts, etc., as opposed to continual devaluation for the yuan. We think the market is pricing, given carry, given where forwards are, 6 to 7% devaluation over the next 12 months, and we think that's probably what we see. I don't think we see much more than what the markets are pricing.
Okay, Mihir, we'll leave it at that. Thanks very much for taking out the time to speak with us. Appreciate your views.
Okay, thanks, Tanvir. My pleasure.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.